Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite. She's also president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
Santa's just around the corner, but taking a look at what's happening this week and in the markets and so on, and Janet Yellen's comments about Bitcoin, what really stood out for you this week?
Honestly, I think probably the Alabama election was a big one this week, just in terms of, the Republican losing the seat because of the allegations against him. I think there's been a remarkable wave of these revelations this year. That's got to be one of the biggest themes of 2017 for sure. And I think that, that the other one is its implications perhaps on whether or not the U.S. tax bill gets passed, which is, was tenuous before, but tax reform, now has that one less vote in the Senate. And also I think, that ties in with what, Janet Yellen was saying yesterday, which on her way out, so to speak, was saying, we don't see 4% growth. So you've got this government under President Trump who has come in on a promise of delivering growth as if they're mad magicians in the midst of, whatever negative demographic trends and the fact that there's huge amounts of debt, and that their tax plan actually figures on increasing the debt, so reducing the revenue and increasing the debt. And we know from history that increasing debt when you're already at high levels doesn't in fact increase growth, it decreases it. So I think we're probably at a tipping point. We've had this kind of romantic honeymoon phase where the Republicans were, if you think back to when the Trump election came in and he was elected on this belief that he was a genius businessman and that was going to be enough to turn around the U.S. economy and reinvigorate everything. And of course I was very skeptical of that, apolitically, not because I'm for or against any particular government, just because looking at the facts and the math of what that government had inherited. And I said similar comments when Obama came in, the reality of where we were in the cycle, that being the leveraging debt cycle that had gone to, mad levels and was weighing on the economy. And so, it's not something that any government can magically fix unless they're going to do things like, write off debt, and sort of find ways to restart. But so far, none of that has come through. And I think Janet Yellen is going out, going while the going's good, so to speak, because it can only get more challenging from here. They've hiked 5 times. If you look back at the interest rate profile, we were, it's amazing that the Fed central bank overnight rate at the peak of the last cycle was 5.25 in the spring of 2007, and by 2008 they'd hacked that to zero to 0.25, and then we sat there for 7 years, and then since then they've raised 5 times, and we're now back at this 1.5 to 1.25 range, which is still historically, very low. But if you track that, Jim, you'll see that the reported happiness or contentment of people has been going down since about 2015 again in this cycle. And I think that's directly correlated again to the fact that people have been encouraged through central bank policies and, add debt and stir governments to just take on more debt, spend more than they had. It was always the spend and hope, spend and hope that would somehow drive the economy to higher levels growth, and that would somehow miraculously drive wage growth, and we'd somehow run ahead of this debt monster we've created. But in fact, that isn't happening. People are reporting great financial strife, and this is all when unemployment is still at cycle lows here today, Jim, and as I say, rates have barely moved. So I think we've really had the best of we could ever get in terms of adding more and more debt. We're at full employment for the economy. We're at record highs in debt, and I think that from here, things are going to have to, the pendulum will begin to swing the other way, which means we're going to have to go into the payback and write down phase, and we're going to have, if you listen to the central banks, higher rates, certainly tapering of the injections they've been putting into the financial system. So all of this is not about monetary loosening anymore, it's about tightening. And, from there you have to sort of confront the reality that you've got broke before you got incomes going again. And that's going to be a problem.
Is the goal of governments to try to get enough income for banks that they can raise the pension income rate by 8% a year to make it sustainable, or do you think they even have a goal like that in mind?
Oh, I don't think they have a goal like that. I think that the pension system is, again, funded primarily, or it's been driven primarily by political promises, which have not been backed up by sufficient contribution levels over the past many years as interest rates have fallen, and no one wanted to face those facts, so they have continued to underfund and overpromise, and we're coming to a point where that's going to be impossible to cover up, both with the demographics of more and more people expecting to collect and fewer people paying into these plans. Just as they say, the returns on assets are going to be very muted. There's two ways that we can get back to a robust yield environment. One is through, a large sell-off in corporate bonds and dividend-paying stocks, which, when prices fall, will increase the yield because if the income is not cut and stays the same, and you buy the assets after they've fallen, your yields will be higher, and that will help to provide better income than you can get right now. The problem is that most pension funds are fully loaded already. So in other words, they don't have a ton of cash that they will be able to buy after prices go lower. They're stuck with the current risk to their balance sheet. So they're holding these incredibly overinflated assets that now are paying relatively poor yields to the price that they're sitting at. And unless you're able to, capitalize on that by selling and downsizing and going to cash and then waiting for prices to mean revert and buying them back so yields are better, you're facing a very difficult period because you're fully invested and, as I say, your contributions are not coming in to match the payments that you're having to make. So I think we're coming to a crossroads where there's going to have to be, restructuring, and it's going to be very unpopular, politically devastating, I'm sure, because everyone wants to believe there's a magic bullet, but there in fact isn't. I think Janet Yellen said so much yesterday, even though she's been head cheerleader and, pumping cash into banks was their primary job. They didn't articulate it that way, but central banks really, right from the Bank of International Settlements, which is the heads of all of the central banks of the world that meet in Europe, those same people, their job is really to keep the liquidity in the banking system and keep the profits rolling in that sector. And there's nothing in that mandate that talks about pensions or protecting the public from, really reckless policies that bankrupt us. There's nothing in that about that. So they just will continue to pretend that they've done a great job. When the next financial crisis comes and the assets fall, the debts will not. And people will be horrified once more, no doubt, to see that there's been this horrible mismanagement and abuse of trust left and right. And of course, the central banks will then say that, they can't be blamed for it because they couldn't see anything coming and because, it was the politicians who didn't act. And, the bankers will blame the politicians and the politicians will blame the banks. And, at the end of the day, it's the individual. It's you and me. It's the workers that have to be concerned about what finances they will have to fund themselves into their old age. Many of those people, like Janet Yellen, will have this great pension, which no doubt has been better funded than most. And the rest of us just won't have that kind of bailout or backing. So it really takes, I say we have to really be looking out for ourselves in this environment in terms of managing our own financial picture, and not, going with the madness of crowds or taking the bait that's given to us through the risk sellers and the debt sellers, and really try and be prudent and look at your own facts and make wise decisions. Because, as I say, there won't be a bailout possible for individuals going forward, and that means, we're at this point where, looking into the next 10, 15, 20 years, the decisions you make right now in terms of your financial picture, in terms of whether or not you're indebted, whether or not you have set aside savings, whether or not you're holding a bunch of risky assets, or whether you're, thinking of liquidity first at this point, all those things will set up our financial future for the next, 15 to 20 years. So it's really at a critical point today.
We'll have more with Danielle Park right after the break.
I'm Greg Johnston, CEO of Corral Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Corral Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Corral Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Corral Data, please visit corralsolutions.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome back. We're chatting with Danielle Park. Danielle, another report comes out that Canadian income to debt ratio is at a record high, and it's the highest compared to anybody else in the industrialized world. What does that mean?
It means we've done a terrible job at managing our finances. So kind of what I was just speaking about before the break. In general, Canadians have done a horrendous job. And they've been aided and abetted and encouraged by financial salespeople and banks and central banks who are all about pumping credit and not about how to manage risk for the individual in their finite lifespan. So it means we've dug ourselves a hell of a hole, and it's going to take, a long time to dig out of. And we don't have, oil prices have been falling since 2008. They're still down over 75% from where they peaked in 2008. And the IEA was reporting again this morning that we are looking at greater production increases in 2018 than demand. So we are probably not seeing any bounce back in that commodity sufficient to, pull the engine forward again the way it was doing into 2008. And with the household sector, now prostrate from all the spending they've done on debt the past decade, we really don't have an obvious engine at the moment. So this is an opportunity where we have to, as a country, re-envision ourselves and restructure and figure out more intelligent things to do in terms of catalysts for the economy. And the thing that the households have to do is go into this payback period. I think that, it'll, like I say, when the real estate market weakens further, which I think it will continue to do, we've got more tightening coming into policy. We've got the new rule about the qualifying for the higher rate in the new year, even if you're not borrowing on a high ratio mortgage. All that stuff is going to slow at the margin the amount of buyers that are able to enter this extremely overvalued real estate market that we have in most parts of the country. So in some ways that'll be good. It'll be preserving of those who are trying to, commit financial suicide by taking on these ridiculous multiples of their income mortgages. So that'll be helpful to restrain people from getting into this market too quickly with too little down. but it won't be helpful to those who are currently holding and hoping that they will be able to either flip their property or sell it because they need to downsize their costs, or they're older and they're just looking to, raise more income for their savings in retirement. So all those forces are sort of coming to a head at once, and I think that the balance sheet side of the Canadian household is where they're going to really take a shaking, because we know from all the data that most people have the bulk of any savings they actually have has been in the form of their house. And we know that there's been a lot of financing going on regularly. As rates fell over the past few years, people were continually refining and taking out that equity to spend, and that's why about 100% of the economy's growth in the past 3 years has come from the household sector driven by debt. So again, if we're at the end of that line of credit, and I think we are, even if the Bank of Canada doesn't raise rates here for a while because of the slowdown that's happening in the economy, I think we've had about as good as we could ever expect to get in terms of consumer spending driving the Canadian economy. So we're at peak debt, and we're not likely to see another boom in the commodity sector for some time, probably several more years. And so we really are at this payback period, and it's going to be difficult. I just think, if people realize that, because the other thing, where else do people have savings? Well, they have savings in the Canadian financial markets, and that's where the other major inflation has gone on in the past couple of years. And I think that's where when you get hit in these downturns, sadly, people look around today and they say, I don't think we're going to have a recession because I don't see it in the economic data. But the reality is that we're in these financial market-driven trigger points. So we haven't had recessions triggered by weakness in the overall economy that then spill over to the financial markets for many cycles. What we've had is too much debt-driven, reckless speculation in financial markets that finally bursts and then spills over to the actual economy. And I think that's what we're going to see this time as well. And we've got to be very close to that edge, that tipping point here, because of all the things we can measure, because of the cyclicality of these things. And we can see that there's just not a lot of seed corn put away for people to keep consuming at these levels. So I think, it really takes, now's the time, it's not too late for individuals to sober up and look at their own finances and decide how they can lower their risk. Because otherwise what's going to happen, as it did in the last couple of recessions, is you get a whack to your balance sheet, the asset side, both the price of your real estate holdings, if you happen to have some, can take a hit or be less liquid than you think it is. At the same time, your savings and your RSPs and things, the value of those assets also takes a whack at the same time. And, in there is an upturn in unemployment. So people could also lose their jobs. So what they've got is a heavily correlated, positively correlated assets and income picture. And there's nothing that's there as a buffer in this approach, to help them get through the next downturn or a job loss cycle, that sort of thing. So it really takes planning preemptively now, not when, everything's crashing and you're having to sell in panic to try and raise some cash. And that's why most people are so unable to respond to this properly, because they're not thinking about it proactively. They're following along, following the herd, and then, all hell breaks loose and they wake up in a nightmare.
We'll have more with Danielle Park right after this.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Danielle Park, Danielle, is it too late this year to get a handle on your Christmas shopping debt?
No, I think it's never too late. I think, families need to talk about money. I think that survey after survey has shown that kids that are the most able or responsible or cognizant, in control of their own finances as they grow into young adults are the ones who were able to talk about the numbers and the reality of spending habits and income problems that people have, and that now is a great time to discuss it as a family, to get away from this shame of trying to cover up or, keep people in the dark about how the money's working. I think it's very important. And when you get to a season like Christmas or holiday spending, if you've had frank conversations about your finances with your family, you're less likely to get sucked into spending more than you should or that you have. And of course, polls this month from the banks have done several polls, and a resounding majority of people, 2/3 of Canadians surveyed, said that their spending was already out of control, and that 41% that they were spending money they couldn't actually afford to spend. So talk about terrible financial planning, and not only that, terrible for your peace of mind, right? If you think about what is a holiday about, what is the whole point? It's supposed to be a moment of reflection and some cultivation of happiness and peace, not a wild consumption binge that leaves you with a massive hangover that you can't recover from easily. And if you look at the trustees in bankruptcy, all tell you that their biggest boom season always starts in the new year, when people wake up from what they did to try and get through Christmas, and realize that they can't pay back what they've borrowed. So I'm all for disclosure, discussion, and getting it out in the open. And I think in my own experience with my own kids and my own family, if you can have those discussions, I think that there's a lot more understanding about, what prudent limits are and what makes happiness and what doesn't make happiness. And clearly running yourself into debt to buy things is, to me, it's the antithesis of peace and happiness. And I think that most people will find that.
Well, in my immediate family, we're on a need to have it thing where I need brand new slippers because the ones I have holes in the bottom. So that's a handy thing for Christmas. And for my wife, it's a cut and color at her favorite hairdresser, because you're going to use it anyway.
Very practical things, right? And experiential things, I think, are really important. I think if people could put down their cell phones and actually go outside together and walk around and just be in the world, try and be in nature, all those things are more likely to bring peace and happiness in the season than any kind of consumption, and certainly when it's using credit to afford it.
Danielle, you and your family have a great Christmas.
Thank you, and you too.
Our guest has been Danielle Park, editor of the popular blog Juggling Dynamite. Her website, jugglingdynamite.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our popular YouTube channel is Talk Digital Network. If you have any questions for our guests, you can send them to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.